What do you do when the stock market goes way up? What do you do when it goes way down? Do you buy? Do you sell? Do you hold? How do you keep your emotions in check during all the stock market volatility? We're going to talk about how to cope with it, how to react to it, and what to do on Triple F. Hello.
What's happening?
We are back.
So back.
We're going to talk some finance, man.
Sweet.
That's your favorite topic.
I love it. I do love it.
Everybody likes finance. You know
Who
why?
doesn't?
Because it impacts your life day to day.
It sure does.
You know what I learned when I was young is that finances, and this is what got me
It's
kind of focused on it.
fine.
Finances is fine, but finances has a thread through your entire life.
Yes.
I mean, no matter what you do, man, every time you buy anything, sell anything, make money, invest money, spend money, I mean, no matter what happens, it all has to do with finances.
Mm-hmm. And it's always been like that, whether you were dealing in cash or electronics,
Yeah.
or you were bartering back, hundreds of years ago.
It used to be with gold coins. I mean, it'd be gold coins or, coins with the emperor's picture on it or, I mean, then Waterworld, that came around and suddenly dirt was like their currency. So really money is nothing but just a currency. It's just a way to exchange goods and services.
That's
So,
right.
but man, it's highly emotional.
Oh my goodness. I'm so glad you're going to talk about this because I
Highly
think this
emotional.
is so important
Yeah.
for everybody to understand.
Yeah, we're going to talk about stock market volatility.
Mm-hmm.
And, we've had a pretty stable stock market the last couple of years. Well, maybe not last year as much, but we've had a pretty stable stock market. It's been up like 20, 15, 20, 25% each of the previous 3 years. And it's already this year in 2026.
David's like, cha-ching,
We're up
cha-ching.
10% the first half of the
It's
year.
like, I'm going back on vacation.
Yeah. So the only volatility we've seen so far over the last 3 years is kind of up volatility, right?
Mhm.
So it's been going up. So
This is going to fund your Hawaii vacation that's coming up.
yeah. So let me start with a couple of stats just to kind of get your attention. And this is some stuff that anybody that's been alive that's maybe 40 or 50 or more, you're going to appreciate this. And if you're younger than that, you may learn something. But let's just talk about some stats first. The tech bubble. Everybody heard of the tech wreck, the tech bubble. Back in 2000, March of 2000 to March of 2003, the stock market went down 48%. I was working at the time. My 401k,
Brutal.
I remember, went down 50%. So,
It's
I lost half my money
That's like suicide
in a
watch.
3-year period. So it went down 48%. Now, if I'd gotten out then, I would have really been hurt.
Mm-hmm.
But I hung in there. And so from March of 2003 until October 2007, that's about 4 years, 4.5 years, it went up 95%.
Woo.
Over
Rocket
4
ship.
years. So you're looking at, 20 plus percent per year.
Hopefully you got in at the bottom.
Yeah. Well, I unfortunately, I sat through it all. So I lost 50% before I was able to get my money, but, my 100% back. But if I'd gotten out at the bottom, I would have missed 95%. I never would have got the money back. Then we had, a few years later, we had the financial crisis. And that was the big one where the banks were going out of business. Man, people were like, jumping out of windows and stuff like that. And that was from October 2007 to March of 2009. So you're talking about really about a year and a half or so.
Mm-hmm.
Market went down 57%. And again, I was working. I set my money in the market and in my 401k invested. I lost half of it then. So that was twice now in a 10-year period that I'd lost half of my money. Fortunately, I didn't get out then either. I was too busy working. I wasn't paying attention.
That's good. That's the best way. You just forget it.
Because from March of 2009 to February of 2020, that's 11 years, the market went up 400% in 11 years.
Wow.
400%.
Jeez.
And then I was able to retire.
Lucky you, man. Lucky you.
But that was the financial crisis. And then just when you think it's safe to go back in the water, we have this thing called COVID popped up. And this was the most unusual bear market I've ever sat through. From February 2020 until March of 2020, we're talking about 4 to 6 week period. So we're talking about a 1 month period when they shut the government down, companies shut down. We all were told to stay home for 30 days to slow the spread and wear masks and all that stuff. So nobody was going to work.
Masks.
Businesses were going under, bars were shut down, gyms were shut down. You were shut down. I remember talking to you during that period. In that 1 month period, the market went down 34%, probably the largest decline ever in like a 1 month period.
Wow.
34 people lost my portfolio went down a third in 4 to 6 weeks. It was, and the problem is you're at home watching all this, right? Because you can't go anywhere. Fortunately, then I didn't get out. And so from March 2020 until 2022, you're talking about 2 years, it went up 115%. So we had a great bull market right after that period. Once they decided that COVID wasn't going to be the end of mankind and we could actually start opening businesses again, the market flew up 115%. And like I just said, over the last 3 years, we've had markets that were up 20 and 15, 20, 25% a year. Yeah. And so it's been a great time to be invested. But what it shows you is that the market is very volatile. And we're going to talk a little bit about volatility, about what causes it, how we feel when it happens, what to do, and if you stick around to the end of the video, we're going to tell you how to kind of invest for volatile markets and how to kind of prepare your portfolio for that. So don't get off, like, subscribe, let me know about some of your stories, that you had during all this time, because everybody's got a war story that during the 2000 tech bubble, the 08 financial crisis, COVID, all that stuff. Mm-hmm. So what is volatility? I mean, when you think of volatility, stock market volatility, what are you thinking of? Just in simple terms.
Pain, a roller coaster.
Pain, no gain.
Yeah, that's what I think about.
So there's really a couple different ways to look at it. You can look at it from a statistical view, which we're not going to do very deeply today because that's a really boring way to look at it. But I'm going to mention it just because if you watch TV and you hear about this stuff, you'll know what it is. There's an emotional view, which is what we're going to focus on because that's kind of what we can control. We can't really control the statistical view, but we can control our emotional view.
Sort of. Some of us can.
And so what is statistical? There's actually a volatility index out there. It's called a fear gauge, actually, and it's actually a VIX, or you may have heard the term VIX. And it really measures market volatility. And it's almost like a stock. You can almost look at it like a stock itself. And it goes up or down each day based on how volatile the stocks are. It
depends on what Trump says.
Yeah. If Trump says something really outrageous, not that he would ever, want to say anything controversial or anything, but let's say he says something outrageous, the VIX will just spike, and
shooting up and down.
Yeah. And if he goes and plays golf, for the week or whatever, then things settle down. So, but there's actually a VIX volatility index out there that traders track and the market tracks. But the statistical view that we look at is, volatility measures, what it measures is the frequency, how often, and the magnitude, how much do price moves, do stock price moves and that's for any stock, for any index. There's two indexes primarily. You have the New York Stock Exchange and the NASDAQ. Mm-hmm. Those are the only two major exchanges. There's some smaller exchanges, but those are the two big ones. But it's actually what you can measure and see when you look at the stock market going up and down. It's what you can actually see, and there's actually ways to measure all that. Mm-hmm. There's not much we can do about that. That kind of says that's what the market's doing. Mm-hmm. Okay, the emotional view, which is what all of us kind of do, and what I go through, and what the agony that you're talking about, the pain you go through. It represents market uncertainty. It's rapidly changing investor sentiment. So as an investor, we're really positive when the market's going up, and we suddenly get negative when the market goes down, right? Right. So when your stomach hurts the most, that's usually in a volatile time. We know that the volatility is up. When you're feeling euphoric and like you can go to Hawaii on a vacation, that means the market's probably going up, right? And so it's really, how do you feel? And we're going to go dive deeper into this more, how do you feel thing, and how to respond here in just a few minutes. But but that's really kind of when I say an emotional view, you can always tell how the market is doing based on kind of how you feel if you follow it. Now, some people just go through life, never follow it, never look at the market, and their stomach never hurts, and they never feel the euphoria when it goes up. But most people that are watching this podcast probably have some money in the stock market, and you kind of feel this pain. So what causes volatility? I mean, why does the market go up and down? You talked about Trump all ago. It depends on what Trump says or what have you. That's actually part of it. But there's several factors. One of them is what we call macroeconomic factors. So it's sudden changes in interest. And all these have happened in the last 2 or 3 years. Yeah. So see if you kind of recognize them, what I'm saying. But sudden changes in interest rates. The Federal Reserve raises and lowers interest rates. Unexpected inflation. If inflation spikes or goes down. And changes in employment data. And that's really it. That's really all. Those are the big macroeconomic factors, changes of interest rates, which are really a result of inflation data changing and employment data changing. And then the big one that we've had recently this year is geopolitical events. elections, international conflicts, trade wars, disruptions in global supply chains, all that kind of stuff. And so let's just take for an example the U.S.-Iran conflict that we're currently in. Why would that impact the stock market? We had a disruption of oil supply. They basically shut down the Strait of Hormuz. Oil supplies, the supply went way down. Demand stayed about where it was up, and so the oil price spiked. So what happens when the oil price spikes? Causes inflation. When you get higher inflation, the Fed feels like they have to raise interest rates to tamp down inflation. When you raise interest rates, that's bad for stocks and they go down. And that's why we had kind of, when the war started, we started a trade war last year with the tariffs and all. The stock market took big hits because inflation spiked, which meant interest rates are going to spike. And when interest rates spike, the market gets killed, and it takes a minute for it to settle out. And so you have to, again, it's all that uncertainty. When COVID hits, we're uncertain, so the market sells off. When we get more certainty around it, it goes up. You have a war uncertainty, the market dips. When you have a better outlook on the war, the market goes up. And so geopolitical events are a huge impact on it. Those are things we can't call. We don't know that in advance, right? And then corporate earnings. Anybody that's owned any stocks before, if you've owned Microsoft or Google or Apple or any of them, when they miss earnings in a quarter or when they lower their forward expectations, their stocks just get pummeled. Okay. And when they come out and they really do well and they show big growth, their stocks go up. So it's really macroeconomic factors, geopolitical events, and corporate earnings. And those are the main causes of volatility. There's another smaller one, algorithmic trading. These are some of the traders that have these algorithms that buy and sell stocks by the millions of shares every day based on prices that the stock may hit for really no real reason, to be honest with you. But algorithmic trading, short-term traders, it can kill short-term traders. And so that's kind of what causes it. So let's talk a little bit about the psychology. We talked about emotions a while ago. And so let me know how you feel about these things, like loss aversion. It's said that people feel the pain of a financial loss twice as much, or twice as intense and twice as much as they enjoy a comparable gain. So let's say the market goes down 10%. Let's say you have $1 million. You lose $100,000 and the market goes down 10%. Think of how you feel at that point versus if it goes up to 1.1 million, you make 10%. Which one do you feel worse when it goes down, or do you feel better when it goes up?
I feel worse when it goes down. And I would imagine that that's because we tend to have a target, or, hey, we want to try to reach some sort of number. And we've worked very hard to put that money in those vehicles. And then when we see it go down, we feel like we're losing what
Going
we put
backwards,
in,
yeah.
going backwards, and we're not getting closer, yet we've worked just as hard to get to where we are at that moment.
Yeah.
So I would say definitely going down.
And that's normal. I mean, people feel financial loss twice as much as they feel the euphoria from a financial gain. And so that's an emotional thing. And so what that drives is panic selling. And so when somebody, it's totally counterintuitive the way you should trade, but if you have $1 million and you suddenly find yourself now with 900,000, you don't see any way out of it. You start to sell just to protect that 900,000, and then that's usually when you miss the rebound. And so it drives panic selling, and panic selling creates more downward trend. I mean, the stock market's for every buyer there's a seller, and for every seller there's a buyer. And so if you have too many sellers of stocks, the stock market goes down. If you have a lot of more buyers and sellers, the stock market goes up. It's like anything else. Another part of the psychology besides loss aversion is a recency bias. So when the market corrects or goes down, it feels like the trend's going to just continue indefinitely. I remember during COVID when the market went down for 4 weeks, 6 weeks, I lost like 33%, a third of my money. I didn't think I thought it was just going to keep going to zero. I thought it was just going to keep, you couldn't see an end of it. It's kind of like called the fog of war. But when the market's going down and you're in one of these bear markets and they just keep every day, it just goes down more and you lose another bit and you lose, you just think, man, is this ever going to end? And when you get into, and at the end of the day, it may have been a 3 to 6 month period, but it felt like 3 to 6 years that it had been going down. But it feels like the trend's going to continue, and people ignore the historical market resilience, the resilience of the market. Is just historically. If you look at the stock market over the last 100 years, there've been dips all along the way. But if you look at over a 100-year period, you can't even see them. All you see is just an upward trajectory of the market. And so when you're in the middle of it, it's hard to get your mind around it. And so again, that psychology says, man, I just need to sell and get out of it because I just can't stand it anymore. I'm not sleeping at night. And then the one that really gets people too is those that watch the news and TV. It's called the headline effect. And I tell people actually trade like this. When the media is sensationalizing these big market drops, and you look at it's called the New York Times headline. The stock market is now in correction territory. The stock market's in bear market territory. It just gets people excited. And if you can't dig down below the headline and see what's actually causing it, and then keep your emotions in check, you'll tend to sell at that point too. And you'll tend to panic sell and lose a lot of money. And then when the market's at an all-time highs, you hear, well, the market's at all-time highs. The market's at, it's day after day. And that's where we're at right now. What happens then, you start getting FOMO. And then you want to buy.
Yeah.
And in reality, you need to go opposite of the headlines. So you want to buy when, it's like Warren Buffett always said, you want to be greedy when people are fearful, and fearful when people are greedy. So when the markets are setting all-time highs, you may want to even look at reallocating some stuff or pulling some off the table. When the markets are getting killed and your stomach's hurting and all that, that's usually the best time to buy. You don't get those opportunities very often. You get them maybe every 6 or 8 years, maybe even 10 years, but there are a few times throughout your investing career you'll get a chance to really make an impact in your portfolio and buy when it's the least attractive to buy. But it's all based off of emotion. So if you can keep your emotions in check, you'll become a pretty good investor, and just kind of go against your gut.
Yeah.
Just go against your gut. So how do we navigate it? Our final little slide here. Dollar cost average. We've talked about that. You put a little bit in at a fixed amount, fixed time, every month or every quarter, put a little bit in over time. And sometime you'll buy when it's a little bit high. Sometimes you'll buy when it's low. When it's low, you're buying more shares. When it's high, you're buying fewer shares. And so dollar cost averaging really helps kind of smooth that equation out a little bit. That way you're not trying to guess the top and the bottom of the market. Somebody's been in the market. I've been in the market for now 30, 35 years. You're never going to guess the top. You're never going to guess the bottom. So you just put money in over time, and that's kind of the best way to kind of build it. And that way, you'll always be investing money when the market's in a correction mode. But you're also going to be investing when it's up high. Asset allocation, diversification, balance, mix of stocks, ETFs, fixed income or bonds, cash, money market accounts. Don't have everything in the latest greatest tech stock. And don't have 100% of your money invested unless you're like 20s and 30s and 40s. I tell people at that age, just have everything in the market, because you're going to do much better than you will in fixed income. But as you start getting closer to retirement, 50s and 60s, you have to pull back a little bit, because you don't want to lose half your portfolio when you're 60. And then just rebalance. Take those when the market does go down, take the opportunities to rebalance, build positions back that may have lost some money that you still have, you're still confident about. But those are kind of the ways to kind of get out of the noise. If you try to trade your portfolio often, you're going to get stuck in this noise of stock market volatility. You really have to pull back, invest slowly over time, keep your emotions in check, and don't look at it every day. Don't watch the CNBC every day. Especially if you don't have the emotions to do all that, and just have a nice balanced portfolio and go live your life, and don't sit there and be a slave to the ticker symbol all day long.
Is it okay if I share something?
Sure.
Because I know you've got
real life example.
You've got no. I just wanted to. I think if you've made it this far in this video, you've obviously have learned a lot. Hopefully, you're able to retain half of it and able to execute 25% of it.
And I think 25% of you are still here.
But I think this is something that really helped me to understand investing on like a very high level. And maybe it's something that will resonate with somebody out there. So the emotional piece, what I feel about the emotional side of it is that sometimes you get this perception that people who invest in the stock market and they make lots of money and so forth, that it's just like maybe getting lucky by gambling. Okay. And some people will choose not to get into the stock market because maybe a moral thing, they have a moral conflict. They're not actually working for the money that they're investing and so forth. Maybe they also feel like, hey, this is just not my cup of tea, and it's just too difficult to watch the money go up and down.
I hear that a lot. Yeah.
So, and I think that for those of you who are able to deal with the market going up and down, this is where it's not free. This is actually how you pay for the returns that you actually do get to enjoy.
Yep, it's kind of the price of admission. Yeah.
It is absolutely the price of admission for that money. So the people who are the best at doing what you're talking about are those people that can deal with the emotional roller coaster that you will experience over 20, 30, or 40 years of being in the market. And if you are not able to emotionally pay the price, you will not stay in it, right? You won't stay in it. And this is why we tend to find, at least correct me if I'm wrong, but there is sort of a personality or a disposition to those people who are successful in the market because they're not so subject to emotional shifts. Like they're not reactionary typically. This is what I am assuming here is that if you're going to be good, and you can ask yourself, like, let's say you want to get into the market, right? You can ask yourself, am I emotionally unstable, right? Do I run out and go buy the latest, greatest thing?
Yeah, stock.
Do I need to have the most shiny thing? And do I just splurge and spend my money on just because someone next door has something, I need to go get another purse or I need to go buy a new car or something like that? If that's like the kind of person you are, the stock market is going to be very, very difficult for you to handle that emotional roller coaster because you're just more emotionally driven. And I find that people that are less emotionally driven, more sort of logically based, able to keep their emotions under control, will be far more successful in the stock market. Now, you've had way more experience with this, and you've seen a lot more use cases of people that have come and sat in front of you. Is that true?
Yeah. Oh, yeah. Absolutely. It's really education also. So the more you know about stocks and what makes them go up and down, the stuff we talked about today, it helps you with your emotions a little bit. So when the market corrects, there's always a reason it's correcting. So you have to get underneath that reason, and then you need to figure out, is this a permanent thing or is this just a temporary thing? And so when I look at something like a COVID, for instance, the market went way down. That meant people were selling stocks. They were getting out of stocks. And so I had to ask myself, do I think COVID is a permanent thing? Or do we think our country will actually find a solution to it and we'll get out of it? And then when we do, the market will go back up. And that's kind of where I came to the decision to stay in the market.
So you logically reason
So you have to
through it.
logically reason through it. But you have to kind of understand, the market, sometimes the markets go down for real good reasons, and sometimes they go down for no reason at all. The greatest gift you have is time. And I'll tell you, if you look at statistics of the stock market, if you miss the 7 best days every year, so there's there's not 365 trading days, but there's 365 days in the year. If you miss the 7 best trading days of the year, you'll probably have a negative return in the stock market almost every year, because you've got to be in there. If you're going to set through those down days, you've got to be in it on those big up days.
Yep.
And every time the market's going down in the last 100 years, it's always bounced back. And so what you don't want to, what I never do is I never sell stocks on huge down days, and I never buy them on huge up days. And so that's kind of just a general rule I have. But try to learn a little bit about the stock market. Try to think about the things we talked about in the podcast today.
But you also realize that the market is built to grow.
Yeah.
It is inflation, and the way the stock market actually is structured, it is structured to grow over time.
Yeah.
Right. That is the engine, right? That is that is what the goal is that it continues to grow. And that's why when you look at trends over 5, 10, 15 years, you see it going like this. And so it's naturally going to do it. And short of the country just falling apart and just ceasing to exist, when you're going to have much bigger problems than where your money is.
As long as we have a capitalist society, and we have companies, and we have capitalism, and people still believe in capitalism, and we still go to work every day. Companies pay their CEOs and their boards a lot of money to grow earnings. As long as earnings continue to go up, we keep our currency under control. The Federal Reserve does a good job with that. As long as things stay like that, the market's going to go up. And so, and if it doesn't, like Tyron said, we have bigger problems than just our money in the market. It'll become worthless. But anyway, but the biggest thing you have is time. Keep your emotions in check. I'll tell you, everybody's got emotions. I mean, I can sit here and talk about this, but when the market goes down, I start puckering myself a little bit. So, I mean, I do get excited about this stuff, but I really try not to take action, the wrong action when things are going bad. I really start trying to look for opportunities.
Yeah.
The only way to make money in the stock market is to buy them when they're down, because if you buy everything at the top, you're not going to make money.
Simple.
You really have to buy them when they're down. I tell people it's a pair of shoes. If you go to the store and $100 pair of shoes is selling today for 120, are you going to buy them, or are you going to wait till they fall to 80? You're going to wait till they fall. And so treat stocks the same way. When they go down, they're on sale. Buy them on sale. No reason to pay premiums for them if you can buy them at a discount. And so it just really goes against your emotional sense. It goes against the headline thing I was talking about. When people are jumping out of buildings, you're buying stocks, man. When people are partying like it was 1978, that's when you need to sell stocks. Because what goes up must come down, but what goes down
won't stay there.
Well, normally won't stay down for long. It'll usually pop back up as long as our country stays, in pretty good shape like it is now. So, and that's it, man. That's your lesson for today. Stay calm. And things will work out.
Buy low, sell high.
Buy low, sell high. Don't do the opposite. You'll be broke. That's us for right now, and we'll see you on the next podcast.
All right, guys. Have a good one.